So again, my name's James Bogart. I am the CEO and president of Bogart Wealth. Bogart Wealth is a registered investment advisory firm. We manage approximately $920 million of client assets. It's been going up and down a lot lately with markets. About 700 households, roughly about 90% of those are from major oil companies. Bogart Wealth is a true fiduciary for our clients. We're fee only. Our core competencies are financial planning, investment management, tax optimization, as well as tax preparation. There are 15 of us on our team now, directly on the investment management and wealth management side. We've got our 4 tax partners as well. We have 3 office locations, one in McLean, Virginia, one in Houston, Texas, and one in the Woodlands, Texas. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. For those of you who've heard me speak before, and there are several new households, but we do believe your kids and your parents are some of the largest variables in anyone's financial plan. We've made it part of our firm's culture to give your children access to certified financial planners. You know, and I frequently will say, but you know, what would you do differently now that you know what you know, but back in your 20s or early 30s? And that's typically when we can have the biggest impact on changing someone's financial future. And then one of the calls to actions for many of the talks that we do is actually to sit down and run your numbers. If you haven't taken us up on the opportunity to do that, it absolutely is no cost, absolutely no obligation. It's a tremendous way to establish a baseline as to where your current financial position is. And you'll hear me a couple times talk about ways that we believe that you need to have your plan intertwined with any of the topics that we discuss on. And obviously today we're going to be talking about long-term care, so we'll talk about how that intertwines with a financial plan as well. Now, this is one of 8 different topics that we used to do live, and I am uncertain as to when I'm going to get back to doing live events, but there's no doubt I'm going to continue to do web-based events and continue to record them. And for anybody who hasn't seen, every event that we've done now is now hosted on our new website. And we've got all of the previous ones listed there, and we're going to continue as I continue to do these and record them, continue to host them on. But and we are timely as we continue to add new topics. But the core events that we do, we have one on the retirement planning timeline. We've got one on retirement income planning. I've got one on Social Security and Social Security strategies. I've got one on tax optimization and some tax planning. One on estate planning strategies. We do one on net unrealized depreciation and post-retirement income strategies. We do one on long-term care and long-term care insurance. Obviously, I'm doing that one today. And then Roth versus traditional 401ks and IRAs. This list of topics came from our attendees. If there's something else you'd like to hear us talk about, please feel free to suggest it. At a minimum, I'll add it to an existing talk, or if necessary, I'll create an entirely new one just for that topic. All right, so today we're really going to dive into long-term care and what are the chances of needing long-term care and some statistical probabilities. What are the costs associated with long-term care? And then what's some of the different funding sources to pay for long-term care? And then ultimately helping answer the question of is long-term care right for you? The purpose of today is entirely to educate. I'm not going to be recommending one type of policy versus another. I just want to obviously present the options to you and help with you understanding what those are available to you and kind of how the industry is changing as well. But in order to do so, we need to kind of talk about what long-term care is and what are the probabilities of needing it. You know, statistically, there's a 70% chance that someone over the age of 65 is going to have some type of long-term care need. You know, but interestingly enough, we also have to talk about what's the probability of needing long-term care insurance. And ultimately, if you buy a policy, what's the probability of using that policy? We also, with the same survey, found that a couple of the age of 60, if they buy a long-term care policy, there's a 50% probability that they're actually going to utilize it to its entirety. And there's actually, if you have an elimination period, which I'll explain what that means in a little bit later in the talk, but if there's a 90-day elimination period, there's actually a 35% probability that you're actually going to fully utilize the policy. So in order to talk about what long-term care is, we kind of need to explain the different levels of services and how it's ultimately framed in terms of someone's need for it. So long-term care is defined as the ongoing services and support needed because of a chronic health issue or some level of disability. It means that you're unable to handle some of the activities of daily living, or that you require substantial supervision due to cognitive impairment. Now, I'll elaborate on both of those here in a minute, but when it comes to long-term care, there's various different levels of care. The three main categories that are discussed are skilled, intermediate, and personal care. Now, skilled care is ultimately when you need around-the-clock levels of support. Typically, it's that kind of quintessential long-term care facility or assisted living facility. Intermediate care is a step below that, where sometimes you can actually stay at home and bring in licensed care providers. And then personal care is really ultimately kind of the entry level, where you just need help with some of those activities of daily living. Now, long-term care does not necessarily mean that you're going into an adult facility or some level of assisted living facility. There are various settings or environments where you can get long-term care support. And ultimately, that's going to come down to your personal situation and what type of quality of life you're looking for as well. Now, in order to qualify for long-term care, someone needs to not be able to perform 2 of the 6 activities of daily living. These are defined as bathing, eating, dressing, toileting, transferring, which means the ability to move from bed to chair, or continence. Now, another way of qualifying for long-term care is what they call cognitive impairment. And this one actually can be somewhat vague, to be perfectly honest, but it's defined as a condition that requires substantial supervision to protect yourself or others due to dangers of health and safety. Now, the typical ones are Alzheimer's, brain injury, or strokes. But with long-term care, a lot of people just assume you have to be old in order to be categorized as long-term care. You can have a stroke at an early stage of life and still have a long-term care need. And you still can recover and then have a full and meaningful life, but you could still potentially need to have some level of care associated with it, which might not be covered by a typical medical insurance policy. As I mentioned earlier, there are different places to be able to receive long-term care. You can do it at home. There's adult daycare facilities, there's assisted living facilities, there's nursing homes, and then there's also hospice facilities. Now, when we talk about the need or the duration of the typical stay, what we found is that most people are able to stay home initially first. So they say 67% of those that need long-term care, the average time frame is 3 to 5 years, and you're able to stay at home. Nursing homes, it's about 20% of those that have long-term care needs. And on the back end, it's 2.3 years. It could be even less than a year. And then assisted living facilities, which is kind of that intermediate level where you're not necessarily needing full around-the-clock care. Typically, it's between 2.5 to 3 years. It's not uncommon, though, for someone to need multiple levels of care. I mean, for example, mom and dad could need help at home, and we bring in some care support for a period of time, then ultimately becomes a little bit too much of a burden, either from a level of care or on family. And then we might need to put them into like in a nursing home or maybe even just assisted living facility to ultimately help with some of that quality of life component. So what does it cost? And these are 2019 numbers. I do highly encourage you to research the cost for your geography. This is the national median numbers. And so for home health care, which is really defined as bringing in either homemaker services or some level of home health aid, those actually can vary pretty dramatically. But for the national median, it's about $4,290 a month. For home health aides, it's about $4,385 a month. Now, an adult daycare facility, this is where you would bring mom or dad to or yourselves to, it's about $1,625 a month. Assisted living facilities are about $4,051 a month. And then when it comes to nursing homes, this is where it obviously gets a little bit more expensive, higher level of care. National median cost is somewhere around $7,513 a month for a semi-private room, so a shared room. Or if you want your own private room, it's about $8,517 a month. Now, again, this is national median. There are very dramatically different levels of care. I can speak to our family. We actually had a grandparent of mine who needed to go into a nursing home themselves, and they also needed a higher level of care because of cognitive issues. They had memory issues. And in the Northern Virginia area, it was almost $14,000 a month for that level of care. So as I mentioned, these national averages, it's important to look at your area and where you're at, what those cost drivers are going to be there. And everyone's going to be very, very different in that regards. Now, we did kind of an example for Texas, just breaking it down to get a little bit more granular in terms of what those costs could be. So, for example, if you wanted to stay home and just have 2 skilled nursing visits a week, on average $150 per visit, that's going to be $1,200 a month. If you need 6 personal care visits per week, it's about $1,056 a month. If you want some meal prep, and so, if you're at 5 days a week, $5 a meal, there's another $100. And if you need some kind of physical therapy or physical therapy visits, usually it's 4 visits a week. It's about $120 a visit. There's another $1,936. So that's going to bring that long-term care expense number just to right around that $4,300 number we were talking about. And that's an additional $51,000 a year of cost. So over a 3-year period of time, we're talking about $154,000. And one of the biggest risks that we talk about with long-term care, or the need for long-term care, is typically if you have a couple, husband and wife, well, let's say, for example, the husband, which actuarially the men go into or have long-term care needs first. Well, let's say all of a sudden they have this need, which is dramatically increasing cost structure, while the surviving spouse still has to maintain home, normal lifestyle, et cetera. Well, if you were budgeting, let's just say you're living on $100,000 a year, and that's what we've built the plan out for, and then all of a sudden you tack on an extra $51,000 a year of expenses, well, that's going to dramatically impact a portfolio. And that's why we just have to talk about long-term care. We have to talk about the risks associated with it and ultimately how we want to hedge it. Now, every one of us has had different potential experiences with long-term care. There's the who, there's the where, how is it paid for, who provides the care, how long does the person need the care, was the care expected, was it unexpected, and how long, how did it have, how much of a long-term impact did it have on the family? And this is why I think it's really important for any family to have that discussion and be more open earlier on as to what the level of expectation is for long-term care. And is it your understanding, and you should convey this to your children, you want to go into a long-term care facility, you don't want to go in a long-term care facility, you want to stay home as long as possible. And if that's the case, then who's going to be providing that care? Where are the resources financially to cover the cost of those types of things? We had another grandparent where she was able to stay in her home until her late 90s. But because of it, we had to bring in caregivers earlier on, which ultimately made her cost structure higher, but earlier. Now, I would make the argument that it was still cheaper than her going into a full-time nursing home, but it did require a tremendous amount of coordination, which then created a significant amount of family burden associated with it. So when we talk about who pays for this, there's a lot of misconceptions when it comes to kind of long-term care services and how it's paid for. But there are private companies and health insurance providers that pay for some. Obviously, personal assets and family that can help pay for it. There's Medicare as well as Medicaid. And then lastly is long-term care insurance. Now, one thing that's very interesting, though, is statistically what pays for most long-term care, 42% is by Medicaid, 6% is other public programs, 22% by Medicare, and that actually covers about 70% of the typical, and this is a median number, of coverage costs or costs associated with long-term care for America. And then 16% pay out of pocket, 8% for private insurance policies, and 6% for other private policies. Now, other public, just to kind of clarify that's typically veteran affairs programs. Some might be state and local programs or general assistance programs. Other private falls into that category of other types of healthcare insurance. But the point here is that the vast majority of long-term care costs across the U.S. are covered by social programs, not by private policies. But most people think that healthcare insurance will cover their long-term care costs, and that couldn't be further from the truth. So when we talk about medical insurance, healthcare insurance, it's skilled acute care only. In no way, shape, or form is it designed to pay for long-term custodial care. And it's important to embrace that kind of very, very early on. So if that's the plan, then it will or potentially will put a significant strain on your personal assets and ultimate savings. And this is why we say that long-term care really is a family issue. You know, if you have a need for long-term care services, how is it going to affect your family and or surviving spouse? Is the assumption that your surviving spouse or children going to be handling the burden for care? And then ultimately, what's the impact on lifestyle, personal work commitments, and then naturally, physically and emotionally as well? And that's why we're such big believers in have that plan in place. And we're going to talk about the cost of covering the different ways of covering the cost of long-term care and helping incorporate that into your plan here now. You know, and so when we talk about out-of-pocket, you know, there's really 4 ways of covering long-term care. The first is the default. You self-insure the risk. You know, but my preference is that if you're going to self-insure the risk, let's go into it knowing that that's our plan, not because we didn't think about it or we waited too long to create a plan, and then ultimately that's the only option we have available to us. The last 3 are where we buy some kind of insurance policy. You know, and I'm somewhat biased in that I still feel that insurance in any way, shape, or form is a poke in the eye. It's a cost to you that ultimately the benefit really isn't for you, it's for your family. And that's where, even with long-term care, when we talk about the need to pay for long-term care insurance, ultimately it's to hedge a risk. And the risk would be that there's assets left to go to either a surviving spouse or to your heirs. And if you're of the mindset that, hey, you know what, I don't really necessarily feel the need to leave a portion or a significant amount of money to my children, ultimately, as long as I have enough to cover my needs, then in most cases, that's going to push you in this category of self-insure. But when we talk about the different types of insurance policies, there's really 3. And when it comes to the first one, think of it very similar to term life insurance, except for change the terms to talk about long-term care. So with term life insurance, for example, you can pay for a $100,000 policy for 5 years. You can pay for a $3 million policy for 30 years. Obviously, the more coverage with it, the more expensive it is. Now, with these types of policies, I view them 2 risks. The first is the true use it or lose it. So let's say we buy something like that and we're able to pay for it incrementally each year for the next 20 years. And let's just say you've paid into it for 20 years. Well, if the car accident happens or terminal illness happens, well, if you didn't use it or the benefit wasn't there, then there's nothing left behind for the kids. The second risk is something that's becoming more significant as of late, and partly why we're seeing a lot of insurance companies getting out of these types of policies is because the insurance companies are able to now go back to the states where they issue these policies in and say, hey, look, healthcare costs have risen dramatically faster than we modeled them to, and so we need to increase premiums. We had a 70-year-old client here recently that his insurance company increased his premium by 72% in 1 year. That to me is a risk and not something that we're necessarily planning for. And so ultimately we have to make a decision. Do we keep the same level of coverage and just pay more? Do we change the level of coverage? Or do we make some level of adoption or a change in the plan relative to the potential cost of the insurance policy? And that's why between those 2 risks, we're starting to see those insurance policies become less and less popular. And ultimately, a lot of the companies that previously were issuing them, they're still honoring the policies that they had issued, but they're not necessarily writing new ones. And so we've kind of seen this shift in terms of long-term care insurance coverage, moving to more of what we would call asset-based long-term care, where it might be using some type of insurance vehicle and then putting long-term care riders on top, or we do something kind of like a prepay. And I'll talk a little bit about both of those here in a minute. So when we talk about, you know, that self-insurance, kind of going back to the beginning, you know, obviously you need to be willing to liquidate assets to cover the cost, and it might have an impact negatively on what we pass down to the next generation. If we run out of money, then at that point, we're going to be relying on family members or government programs like Medicaid to pay for long-term care coverage. So in order to kind of clear any misconceptions, we're going to talk about Medicare first. Now, Medicare is when you turn 65, you move on to Medicare. Most of the clients that we work with, they sign up for Part A and Part B, then they've got some type of Medicare supplemental policy that sits on top. And again, this is for their healthcare needs. It's not at all in any way, shape, or form designed to cover long-term care expenses. It does pay for costs of a 3-day hospitalization. It pays for the full cost of skilled nursing care for the next 20 days. And then it pays for part of the day 21 up to day 100. It pays for absolutely nothing after day 100. So if you have a long-term care need, and ultimately you're going to need care after that day 100, this is where we need to kick in and have a plan. Medicare is a federal insurance program that provides only limited coverage. So if there's any takeaway from today's talk is that Medicare cannot be your long-term care solution. Now, I do know households, my grandfather was one of them, where as soon as he hit day 100, came out and went home and ultimately relied on family. And now, obviously, that's your choice, that's your call. If that's what you want to do, fine. But recognize that does have not only an emotional and physical toll on family members, where, for example, I look at my dad and his siblings, they were all working. And that was the assumption, is that they were going to work and help take care of my grandma when she was getting sick. And you got to be careful in terms of if that's really the plan or the assumption, make sure you're having that conversation early on. Now, we'll compare that to Medicare. Medicare will still also cover some of those costs. Now, again, this is day 21 to day 100 for home health care service. It could cover some of the part-time nursing care needs. It does provide some custodial homemaker services if you decided to come home. But again, it doesn't cover past day 100. So something to be mindful of. Now, we compare Medicare to Medicaid. Now, the name sounds so familiar that a lot of people commonly confuse them, but Medicaid, not Medicare, it's a joint federal and state program that does pay for long-term care expenses. And as I mentioned earlier, Medicaid pays for approximately 49% of all nursing home costs. It's about 62% of the patients that are in long-term care. However, Medicaid is a means-based program. It's also going to dramatically limit where you can receive your care. And it could be geographically very inconvenient for a household, but it also could be just nowhere near the level of care that a household might be okay in terms of what their mom and dad would be, what they would be okay with for their mom and dad staying into it. Now, every state with regard to Medicaid qualification is going to be different. Each state does establish its own eligibility criterion. In most states, it is income-based. So they will look at income caps. So for example, Texas in 2019, if you had to make under $28,000 of income or $56,000 if you're married. Now, there's also an asset limit. So in most states, that asset limit is $2,000 of assets. There are some assets that aren't counted towards it. So for example, a personal home residence, if that surviving spouse is living in it, one car, some household and personal belongings, term life insurance, as well as burial plots and funeral expenses. All of those are not counted towards that qualification for Medicaid. Now, ultimately, if that is the plan, something that you want to consider or have that as part of your long-term care plan, then we need to look at planning, and we need to look at planning as early as possible for Medicaid. And by the way, we'll talk about the benefits and cons here in a minute, but you might be in a situation that this is the only way for your household to be able to survive. We had a couple where they had done a great job saving, and ultimately their spending was a little bit higher than I would have liked to have seen it. But the wife had developed Alzheimer's in her 50s, and the cost of her care for Alzheimer's was dramatically deplenishing the portfolio, where it was dramatically jeopardizing the husband's ability to still be financially solvent. And so because of it, we had to do some Medicaid planning, because ultimately that was the only way. Now, that's one of those categories where we talk about how do we plan for it? Well, this is where we want to use assets that count to purchase assets that don't count. For example, you might want to use some of your savings to go buy a term life insurance policy. We also might want to consider transferring assets to irrevocable trusts. Now, I'm going to put a caveat to this. There's something we got to be very careful with, as well as giving away assets. Now, when we talk about the pros and cons, and I'll come back to talking about things we need to be careful on, the benefits would be that they allow us to qualify for Medicaid as soon as possible. It allows us to protect a healthy spouse who's going to need financial resources for an extended period of time, or potentially preserve assets for loved ones. Now, some of the drawbacks is it's potentially problematic ethically for some people, where we're talking about transferring assets or sheltering or hiding assets. That could have an ethical problem for some. It's going to require you to give up the rights to your assets. So again, because we're transferring assets, we're moving them to kids or irrevocable trusts, and that potentially will be cumbersome in terms of needs now. And then obviously every state has different Medicaid laws. So if this is a strategy that we're wanting to pursue or we need to pursue because that's the only way to protect the surviving spouse, we need to bring in an elder care attorney to help with drafting these types of things. And that in itself can be costly as well. Now, one thing with Medicaid planning that we need to be very cautious of is as we transfer assets, there are look back provisions. Now, for 60 months, they can look back at what you've transferred out. So theoretically, we need to plan for this 5 years in advance before any type of long-term care need arises. And that's where I would say, hey, there's no way of knowing when a long-term care need is going to arise. It's very difficult to plan for this and ultimately give away a bunch of assets far in advance of when we potentially might even need them. But just to give a quick example of this, one of the ways of doing this is, let's just say you transfer the value of a house, call it $400,000 or $400,000 worth of equity, over into a child. Well, what's going to happen with this look back provision, and again, this is assuming you gave it away within that 60-month window of time, they're going to then come back and say, in your area, long-term care costs are going to be about $4,000 a month. And because the house is worth $400,000, that's going to say that you're now ineligible for Medicaid coverage for the next 100 months. That's almost 8 years, a little bit over 8 years, excuse me, that you're ineligible for using Medicaid as part of the long-term care plan. So we got to be very careful about it, and we got to look at it from a planning perspective. Now, a couple other ways of looking at long-term care or how to pay for it. One option might be using reverse mortgages. Now, a reverse mortgage, it's not my go-to way of recommending this, but if it's ultimately the only way to do it and our desire is to still stay in the house, it allows us to borrow against the equity of the home. You can receive cash now and you can use it for the long-term care costs. It allows you to still stay in the home. It does also not have any mortgage payments, and the loan is then repaid when you vacate the home. The big negative I have with reverse mortgages is the expenses on these are pretty high. And ultimately, if one of the intentions is to leave money to the kids, this might not be the path that we want to do. But it is an option available to you. And if that's the only option and you really want to stay in your home, then that's one that we want to look at or pursue. All right. So one of the conversations we have a lot of times is, should I buy a long-term care policy or should I just invest the money? And so one of the things that, again, most insurance salesmen are really keen on jumping on is leveraging your cash or leveraging your dollars. So just in a hypothetical example here, let's say that we buy a long-term care policy with $150 of daily benefit. It'll cover 3 years, and it's got a 5% inflation component on it. That's going to cost $3,042 of annual premium. Now, by the time it compounds after 20 years, it's going to be worth about $435,000 of available benefit pool. And if I compared that to, if I had just invested that same $3,042 at a 5% rate of return after 20 years, that's going to be the equivalent of about $105,000. Now, again, this comes right back into that whole discussion around what's the probability of need versus using it, and if you ultimately just want to make the decision of self-insuring. I can get behind this leverage component. 435 is obviously more than 105, but ultimately it does also come down to what other assets and available means are there to cover the expenses. But this is typically when we talk about that option 2, which is the pay per year. This is also the one that we've seen these premiums increasing dramatically faster than what they're initially modeled on. So it's not safe to assume that the cost is going to stay flat at $342 per year for the rest of your life. And ultimately also that same discussion around the use it or lose it, that if you have a car accident or a terminal illness, and if you've paid into this thing over an extended period of time, again, 20 years, it's over $60,000. Well, whatever you've paid into it, it's gone. There's no residual value left over. And for those reasons is typically why people decide to pursue other options for long-term care insurance. Now, the benefits for long-term care insurance would be, it does allow you to protect retirement savings. It does allow you to spend quality time with family. You can gain some level of financial support. There are significant concierge services with long-term care policies that can help with generating the services or bringing in the care that you need, whether it's advice, whether it's resources, whether it's locations. And in some ways, it will also allow you to preserve some of that independence. Now, a serious accident or debilitating illness can happen at any point in time, which is also why they typically say, buy long-term care when you're ready. 41% of those needing long-term care are under the age of 65. This might be the car accident scenario. I mentioned that example earlier with someone having a stroke when they were in their 50s. And so the cost of long-term care insurance is based upon your age. And so the insurance salesman is going to say to you, well, if you know you're potentially going to need it or want it, buy it early. I would say that I really want to make sure that when we're making that decision to retire, that we've at least addressed this conversation. And if it's going to be, we're going to move forward with insurance, let's go ahead and move forward with insurance. If it's going to be that we've made the decision to self-insure, then that's the decision. We don't revisit it, because ultimately, as you get older, the cost of long-term care is getting more and more expensive. At the same time, too, we now are running a higher level of risk that we're going to have something develop that potentially would make us no longer insurable. And so that's where, if you're going to do it, let's do it as early as possible. I think it really is appropriate to do it in conjunction with retirement timeline. And the only caveat I'd say to that is, if you're working past the age 65, let's address the conversation at some point between 60 and 65, because once you get over 65, your options start to get dramatically limited. All right, just to give an example, most long-term care policies, and again, this really categorically falls into that third bucket where we use an insurance policy, whether it's a life insurance policy or an annuity policy, and then we put a long-term care rider on top. It provides a pool of money that's available to you. So, for example, long-term care today might have a cost of around $219,000. 10 years from now, that same cost is going to be about $322,000. 20 years from now, it's about $475,000. 30 years from now, it's about $699,000. And the point of this is that long-term care costs have been rising faster than inflation. And so as we're monitoring or reviewing what the need is or the potential risk is, we need to have this discussion more sooner than later. If you're doing retirement planning and you're 50, 30 years from now, this is a very realistic number. That could be potentially what the cost would be. And again, these numbers are talking more about private room home care, private room assisted living care, but the real numbers, and it's something to be planning for. All right, so a long-term care policy does pay for benefits with licensed healthcare providers. You are unable to, and again, they start to pay based upon being able to not perform 2 of the 6 activities of daily living, or a doctor has deemed you to be a cognitive risk either to yourself or other. And just as a reminder, those activities of daily living are bathing, continence, dressing, eating, toileting, or transferring from bed to chair. All right, so a long-term care insurance policy could potentially pay for care in home, assisted living facilities, or even nursing homes. One thing that we commonly will talk about in some of the more legacy plans, some of them only covered one of them. And a lot of them didn't have even the option for paying for services in home. We have seen a change, at least in the insurance company's desire for this, because ultimately, if they can pay for cost of in-home care, which is dramatically lower than going into a facility, then they're going to push that way as well. So we've seen a lot of the policies morph to being more all-encompassing in terms of the options available to you for covering care at different types of facilities. Now, a long-term care policy may actually help keeping you out of a nursing home. For example, the stay-at-home benefits allow you to get the care you need while you're at home. They might be helping with household tasks like cleaning and meal preparation, might be personal tasks like bathing or dressing, services provided by visiting nurse or a home health aide. They can also even cover some of the costs for special equipment like walkers or wheelchairs or respirators, or even hospital beds that you can bring into the house. It also potentially can cover some of the costs for home modifications like installing ramps or some of those elevators for stairwells. So something to be looking at as well. I had a question come in. You may answer it, but what amount, coverage aside, of your monthly net income do you recommend spending on long-term care, particularly when it comes to hybrid policies? Oh gosh, that is a great question. Part of the analysis with regards to how much you should spend versus what the risk is, ultimately still comes down to what level of the risk are you comfortable self-insuring yourself. And we can talk about probabilities of need all day long. And ultimately, when it comes down to a household's financial viability, it's hard to say, you should have 5% of your monthly expense or your annual expenses go to long-term care, or 10 or 15 or 25. Everyone's going to be a little different in that regard, specifically because of what they would have on the back end in terms of desire to self-insure some of the risk. Long-term care to me is one of those, and I go back to that comment I made earlier, it's an expense. And ultimately the expense is being borne in order to protect surviving spouses or assets transferring to heirs. When it comes to the level of coverage, that really comes down to what can you afford? And every household is going to be very, very different in that regards. If I had to talk about kind of general rules of thumb, with those hybrid approaches, I would say that if we're going to do kind of that prepay approach where we're taking a lump of cash, I don't want to see any more than 3 to 5% of your assets go into something like that. And that's on the high end. And that's really fully covering most of the risk. I typically would see, for a household with $3 million portfolio, they might potentially be okay doing a $200,000 all-in expense into these, but that's still, to me, again, on the high end. If we're going to do the monthly expenses, I wouldn't recommend seeing anything more than $5,000 a year for those types of policies. And again, I'm going to put the big caveat that every household is going to be very, very different in that regards. Let us help you with working those numbers as what's the appropriate amount. All right. And it's important to talk about long-term care insurance policies don't replace informal care typically provided by family members. It simply builds the infrastructure, more the financial resources, as well as some of those concierge resources to give family members the resources they need to get you the level of care that you need. It's important to talk about why you potentially would want a long-term care policy. Many different types of insurance are there to help protect you or your assets or your family. Automobile insurance to protect your car, homeowners insurance to protect your home, life insurance for your family, disability insurance to protect your salary. So the question becomes, is a long-term care policy appropriate to protect what's transitioning to surviving spouses or heirs? And that's where every one of us is going to be very different in terms of what our comfort level is with paying for those types of things. Great example, look at homeowners insurance policies. Your deductible directly correlates to what your level of comfort is for self-insuring some level of a risk. If you're okay having a $1,000 deductible for every instance of home issues, that would be one level of coverage. I've seen people who are only okay at $250 per occurrence. I've seen people who are okay at $10,000 per occurrence. Everyone's going to be different, and that's the same conversation around long-term care. So some of the key elements to talk about are key features. So the benefit, this is the amount of benefit that's payable. The benefit periods, how long are the benefits going to last? The elimination period would be how long does it take before the policy will kick into effect? Location of care talks about, does the policy cover care in different settings? And to the point I made earlier, most of them now are very transparent in terms of covering multiple levels of care. And then lastly is inflation protection. Will your benefits keep up with the rising costs of inflation? And that's where every single one of these policies is going to be structured different. We are not going to, Bogart Wealth is not insurance agents to sell these policies. We're advising on what makes sense in your situation. And if we want to move forward, we'll bring in a licensed agent because we don't want to have any level of conflict of interest or recommendation associated with making those policies. I touched on this earlier, but some reasons to consider long-term care now. You're never too young to need long-term care. It's never going to get more affordable, and if your health does change, it can potentially disqualify you for being able to even get a long-term care policy. For example, if you develop cancer, well, that could have a detrimental impact on the ability to qualify for long-term care. I just had another question come in. I have a crystal ball question. Okay. Any thoughts on how the impacts of COVID, governmental spending, and political push towards more socialized benefits might play into strategies for long-term care for more affluent persons? I could guess that increased socialized benefits for lower income folks would lead to more spend for more affluent folks and less share of the pie for whatever the new social programs might be. and therefore have long-term care strategies more important? Oh boy, that's a loaded and somewhat political question. There's no doubt with the amount of money that we've spent in terms of response to COVID, that there's going to have to be some level of adjustments. Whenever you have a large amount of fiscal spend, there's only three ways to pay debt back, and ultimately not paying debt back is not the answer. But it's either going to be your economy has to grow to offset the cost of the debt, you have to increase taxes, or you have to inflate it. And one of those things that when we talk about social programs, well, there is definitely a push for increasing social programs for lower income households. You're just going to see a lot of pressure because of the level of debt that we've accumulated and how much more we can do on the social side. I do think that we are going to see a reform in tax structure. This is personal opinion, by the way, but I also think that we're going to see reform on Social Security policy as well, in addition to Medicare policy. Every state is going to be different with how they respond to those Medicaid types of programs. But again, need is going to increase based upon resources diminishing, and I think ultimately in a higher tax environment, you're going to see a little bit more of a redistribution of wealth. We've seen some rumblings of means testing for some of these social programs, Social Security being the biggest one. I have a hard time believing that that's going to get passed. But again, anything's possible in this type of environment. But I would say that it's safe to assume that there will be change that does happen. I don't know if I can answer that one a whole lot more specifically, but I do think that we're going to see reform. I do think that we're going to see reform on the healthcare side. And I ultimately think that we might even see some price fixing happening on the medical side too. But post-COVID, I think that part of what we're going to see is our supply chains were dramatically exposed, or excuse me, lack of supply chains. And I think that one of the big shifts that we're going to see in probably the next 12 to 18 months is a dramatic repatriation of a lot of the needs that we have as Americans. Whether it's ventilators, hospital beds, gowns, masks, a lot of those things are going to come back to the U.S. Now, I can make an argument that that's going to be good for the economy in terms of economic development, but I also think it's going to mean it's going to be at a higher price point. I also think, based on, again, what we're hearing or what I'm seeing, is that a lot of Americans are going to be okay paying more for goods produced in America, but it is also going to lead to higher cost pressure as well. So something, again, just I think more to come there. All right, so let's come back to long-term care a little bit more specifically. Why not purchase a long-term care product? Well, we've talked about some of these already. There is no money-back guarantee. Premiums can be expensive depending upon the need or level of care, and payments can increase or vary dramatically. And that's why we've seen this shift towards these asset-type based long-term care programs. So some individuals who adopt the kind of self-insuring approach, they like it because they can have more control of their assets. There is no premiums or cost, and anything left over, it's left to go to the kids. We don't have to worry about the use it or lose it type of scenario. But more clients with affluence, they are reviewing these asset-based programs, and ultimately, we talk about hybrids or a prepayment type of approach. We've come to the conclusion that it's okay to consider them, again, because of those leveraging components. But if you find yourself in that self-insurance camp, we should look at alternatives. And I'm not going to name any of the specific policies. There's several of these insurance policies out there now that kind of cover this advanced payment or hybrid approach. But if you're of the mindset that a portion of your portfolio is dedicated or set aside for long-term care expenses, ultimately you're not going to put it in a risk-on or risk-oriented type of environment. So again, let's just use 100,000 as the number, where you can go ahead and keep the 100,000. You're probably going to put it into CDs, which right now, CDs aren't paying anything. On the aggressive end, we're at like 0.4%, but the money's there. You have all the control over it. You can control how you spend it. You can control the level of care. You control the level of care provider. You might not need a registered nurse to come in for some of the things that you have. If you're self-insuring, you have that full flexibility. However, you're bearing all of the cost. Whereas if we consider something where we call them prepaid policies, where instead of putting the 100 grand into a CD or a low risk environment, you might actually put it over into one of these accelerated programs where we just did one for a couple where we did 100,000 for the husband, 100,000 for the wife. And the 100 that the husband put in immediately got him $435,000. For the wife, $385,000. And this couple was 60 years old, by the way. Now, the reason that the wife had less is because actuarially she's got a higher probability of need, so the leverage wasn't quite the same. But there weren't any additional premiums past the initial amount that they put in. With those policies, they're getting a multiple off of the cash. So your 100 in the husband's case was 435, wife's case was 385, and then there's an inflation component that's built off of those higher levels for the 435 and the 385. It is an attractive option for somebody who's considering self-insurance because ultimately this type of policy will still have some type of money back guarantee. Now, most of these policies will have what we call redemption periods. So there's a penalty or a fee associated with cashing them in early. They do also have life insurance built into them. So if you put 100 in, you're going to be able to have something that and you don't use it, something that's left behind that goes to your heirs. Now, I will say the life insurance is not very attractive if you're looking at it solely for the life insurance, but it's nice to at least have that residual care amount in there. And as I mentioned, they already have those long-term care benefits built in. Also, with those types of policies, they don't have any deductibles or elimination periods, so you immediately have access to the funds as soon as you're deemed to have a long-term care need. Obviously, premiums will never increase. It does provide some level of tax advantage. You can choose the choice of care setting. It does have some international benefits as well. Hit the button too quickly. The point with all of this is that we want to make sure that long-term care planning is part of your overall financial planning strategy. At a minimum, as I mentioned, in conjunction with retirement, we need to have these discussions and we need to be adequately preparing for them as early as possible. We incorporate it as part of our planning process. And as I mentioned, if it's something we want to move forward with, we're going to bring in a licensed insurance agent to be able to actually sell and solicit those policies. But when we are looking at those options, we want to make sure that it's all encompassing. In terms of the checklist that we're recommending or take away from today, explore the costs. Know the cost. Know what it's going to cost in your particular area or where your kids are and you want to be. Assess your personal financial situation. Let's have a plan, and then let's also talk to the family about what you would like your long-term care plan to be. Look at care options and potentially what the financial implications of those are going to be. And then also one that's not necessarily related to long-term care, but it's one that we find that is commonly overlooked is make sure that you have your healthcare directives in place. And also I'd put the caveat in there, make sure the people that you are putting in as your healthcare directive, they're still alive. Because ultimately you might have done them 20 years ago and things could change. They could even potentially not be the person that you want them to be anymore, or that healthcare director to be anymore. So that's all I had for today. I do highly recommend, if you haven't taken us up on the opportunity to do a plan, let's absolutely do it. It's no cost. It's absolutely no obligation to you. And we're a great resource to talk about all of these different options, even far beyond just the long-term care. That's one piece of the overall. I did have a new question come in, sorry. Some private long-term care facilities do not accept Medicaid since they receive less from them than the insurance out of pocket. Other long-term care facilities will accept Medicaid, but will have a limited number of beds devoted to Medicaid. So there may be a wait list. In addition, they may require a minimum of 1 or 2 years of non-Medicaid payments out of pocket before they take a payment for Medicaid. So planning to identify the facilities that meet your requirements in advance is important. Yeah, thank you. That's a great comment. You definitely want to make sure if you're thinking Medicaid is part of the solution, we should start circling that list and also make sure that we're identifying and procuring the facilities as part of that planning process. Yeah, thank you for that comment. We do have a couple events coming up here in the next couple of weeks. Next week, I'm going to be doing an updated talk on how discount rates are going to affect the ExxonMobil lump sum program. On the 15th of July, I'm going to be doing one on Roths versus traditional IRAs and 401ks as well. And I'll be announcing kind of the updated one. If you have any questions or need anything from us, this is our contact information. As I mentioned earlier, we are recording this presentation. If you'd like to get a copy of the slides, Mindy's going to be following up either later today or tomorrow. and she'll be delighted to send you a copy of them as well. If there's anything at all that we can be a help or a resource for, please do not hesitate to reach out and contact us. That's all I had for today. Thank you very much. Appreciate you taking the time.